Resume the session with refreshed minds. Before proceeding, let's have a small recap. Has today's session highlighted the importance of learning from failures, building confidence with positive attitude, stepping out of comfort zone to discipline, and taking ownership while gaining practical experience, offering meaningful takeaways for personal and professional growth. As we move into our next session, we turn our attention to the crucial subject of investment and fundraising.
Mr. Govind Raman is the founder of Global Wonders, the founder first capital in Melbourne, and fundraising advisory platform that helps startups build investors' readiness and execute structured equity and debt raises.
So thanks a lot. I know it's been a long day, long amount of sessions. Thanks a lot for taking your time. Thank you to the SIES faculty. Thank you to Pankaj Saira ma'am and ma'am for inviting me. I was a student here myself. I did my MBA in finance or PGDM in finance about 2017-19 pass out. So feels very nostalgic. So great to be back. So won't take much of your time. I will try to wrap it up within 20-25 minutes at max. So let's get started. You guys understand, I'll try to keep it interactive. We'll have a question and answer session towards the end. But so you guys are aware of venture capital, right? Venture capital, startup fundraising, it comes in the news. Great. So venture funding, there's two sides to it. One is founder raising funds. One is investors who are where venture capital funds invest funds in the company. So being in the middle of both, you get to see the same deal through both completely different lenses. One is to the founder lens and one is to the investor lens. I'll quickly just run you through how it works. So founders essentially see a fundraise as validation, and it's a fuel for growth, fuel for growth for their company, where essentially for them it's a sales deal that they're closing in a long-term basis to get to the next level. How do VCs see our investment? VCs view investment as asset allocation and risk management. We look into basically the asymmetry, contrasting founders' optimistic sales funnel, how founders look at the sales in terms of optimism, how they pitch their company, what pitfalls they face during the deal process, and also how VCs look at the same deal through a skeptical buying engine and see how they collide in term sheet, a lot of psychological bias, essentially how certain clauses needs to be negotiated. So it's at the end of the day, it's the art of negotiation which comes into play between the founder and the investor. Founders learn, savvy founders learn that beyond numbers, storytelling is key. So one is in terms of the company, when a founder pitches a company for funding, they look at traction, validation, and other places that the VCs look at. But the founder tries to pitch to an investor in terms of the pitch. With or without this funding, the wave would be coming, and the founder packages the company as a vision plus proof to convince the VC to invest in the company. So with that in background, let's move forward. Explain. So one simple question would be, why do profitable companies get rejected by VCs? Here, the main objective of a VC is they need to find an outlier outcome. So the way a VC fund math works is if there is 100 crores to invest, they'll invest in, let's say, 25 companies of 5 crore each. At least two of those companies or one of those companies, they hope to be a fund returner, to give a unicorn dollar valuation. So that's the outlier math that they are looking at. And that's the reason why even in terms of a founder, if he's investing, if he's thinking it's a good business, VC is essentially not investing in a good business. They are looking for an outlier outcome that can materially move their fund. This single incentive explains various rejections that happen, that founders are not essentially transparently shared by. So so in terms of VCs and so they also look at various profitable in terms of VCs internal validations that they look at the company. Even if it is profitable, they look at whether the company can be venture scalable. So essentially they look at it as a fund return on company. So for example, a 200 crore revenue top line. You guys understand, all mix of finance marketing students, right? So a 200 crore top line company generating about, let's say, 10% profit is a great company, not a problem. Still can, but the VC will ask, will this company produce the kind of exit the fund math demands? And I'll quickly get into the fund math. So that's essentially what is looked at. And VCs are not looking at 10% return on their investment. So if they are investing 5 CR, they are looking at 10%, they are looking at 10% return on their fund. So if their fund size is 100 CR, they need their 5 CR to give that return. So that's the math they are looking at. So in terms of an example, if a $100 million fund company, as which I just touched upon, the company for an early stage company, if it's 100, or let's take an example of a $200 million fund, and the fund owns 20% of a company. At exit, that company must be valued at 1 billion. So the 20% of the investment of the company returns only the fund 1x multiple of the fund. So that's the major reason why VC say no to merely good opportunities, and the startup VC betting on exponential power law, not on immediate cash flows. So for immediate cash flow generating businesses, debt would be a better option. There are multiple stages of debt, venture debt, revenue-based financing, but this is one reason why venture capital funds do not look at good outcomes, they look at potentially exponential outcomes. Next slide. Now, how does a founder see a company? Founder sees a company as a rocket, and the VCs sees it as a risk. So this is essentially where the asymmetry exists. Founders are selling possibility, VCs are seeing probability. So for VCs, skepticism is rational. Saying yes costs VCs both time, reputation, portfolio attention, and saying no is cheap. So that's why they essentially come back with a polite no. And VC operates on finding reasons not to invest. So I just touched upon what portfolio attention is. So let's say a 100 crore fund is there, and a company VC fund has invested in about 25 companies. And this fund was launched 10 years ago, 11 years ago in 2015. So they might have a portfolio of companies that they have essentially built over a single point of time. So which there are multiple companies. You guys must have seen Grow IPO, which are coming up, which just did come up, multiple other IPOs. So these are essentially returns that the VCs come. So for them, their management is also managing those portfolio companies, and also looking at the how other reputation, etc., works in the company. Now, what are some parameters that the risk parameters that the VC sees in a company, on a founder? One is market size uncertainty, whether the market is too big. Then the next is go-to-market risk. Then is the team execution risk. Even if the team is a strong pedigree, they look at the execution. What's the team execution risk? What is the competitive risk? Regulatory risk. So you guys are aware of the gaming this, right? Overnight, the government kept, it was in progress, it was in build, but overnight, multiple gaming companies had to pivot and switch gears because there was a ban by the company. So regulatory risk and pricing power and churn and cap table and financing. So cap table essentially is one of the structures that a VC looks at when they invest in a company. At Series A or at the early stages of investing, a founder or the founders would require at least 50-60% of ownership in the company. And as the funding increases, the ownership would dilute accordingly. So that's one other thing they look at. And another point they look at is financing, whether the company can essentially have possibilities of financing in the future rounds. Will the next round fundraising happen in a tighter market? So in the 2021-22, there were multiple funding rounds that happened. There was a funding bubble as such. Because of COVID, multiple angel investments, a lot of funding did happen. But then that got followed by 2023 funding slump. Will the company be able to raise funds in a tighter environment? So that's what VCs look at. Then another point that a founder normally tends to be opaque on is the investments committee dialogues or the investment committee debates that happen within a VC fund when the deal manager sells it internally. During my days at Mumbai Angels, and also it happens in various VC funds too, there are multiple IC debates founders never see or hear, and essentially they look at the multiple partners, how the partners buy in, domain skepticism, ownership constraints, and strong, if there is any strong dissenter on the deal, then essentially that also tanks the deal. Now, I did go upon a lot of words here, so I'll just quickly explain. So you guys understand a partner essentially is very technically put a head of department of investing department in the VC fund. So there are multiple sectors. If there is a, let's say a VC fund A, there are multiple sectors. One, deep tech, consumer, let's say gaming. There will be multiple partners, 2 or 3 partners, not more than that for a small VC fund. And they essentially form part of the core investment committee, and the deal manager explains these points, and there are multiple debates that happen. And this takes 3 to 6 weeks, and this is one part which the founder never hears, and that's where they will essentially hear the VC fund going cold at this time, but these debates are happening internally. So for founders, essentially how to sidestep this? They can narrate, so essentially they can focus on the upside, of course, but they can also preempt the downside. They can name the 2 or 3 most credible obstacles that there in the company, how it can be backed with data. And essentially this is where the disconnect exists. For founder, it's validation versus VC asset allocation. Next. So for VCs, the 2 different jobs in terms of, you can take it as a job description. Everyone would be part of the placement season, so there will be a lot of job descriptions. So I'll just quickly give you how a VC's job is and how a founder's job is. Completely 2 different jobs. One is a VC job that deploys scarce capital, time across many options, under a mandate, under an investment thesis for limited partner returns. I went through a lot of terms, so I'll quickly explain what that is. So essentially, every fund has an investment thesis. You guys are aware of Epigamia yogurt? Yes. Great. So there is an investor, Fireside Ventures, who had invested in it in the early stages. I met the partner, and they have a very basic three points on their investment thesis. One, the company generates 10 crore plus revenues on a yearly basis. Second, their distribution is scalable and repeatable across many cities. Third, there is no portfolio conflict. So for example, if Epigamia yogurt is they've already invested in, and Milky Mist, which is another yogurt company, comes for funding, even in their next fund, they will tend to avoid because they are invested in Epigamia yogurt. So this is what investment thesis is. Every VC fund, there are more than 2,000. So every VC fund has its own investment thesis. Now, founders are essentially looking for funds. So VCs are essentially investing money. Do you think VCs have a boss? Yes or no? Okay. So essentially, where do VCs get their money from? With their $100 million fund, that's where they get from limited partners. Very essentially, limited partners are institutional endowment funds, various other funds that invest money, like Saudi pension fund, Canadian pension fund, they invest money through HDFC Bank, ICICI Bank, they invest funds in these VC funds. For them, for which they have to give certain returns to the limited partners as the VC fund, who's a general partner. Now, what is the job of a founder? Founder's job is to keep the company alive, build the product, win customers, hire team, raise capital as lifeline, and essentially make sure the company is operational and payroll is met. And of course, move to the and establish a greater part of the market. So this is how you see both the jobs essentially of the VC and a founder. Now, in terms of asset allocation, the startups for a VC, they are not evaluating one company. For founder, they might be pitching to one VC. But at the same time, the VC associate or a VC fund would be evaluating that founder particularly, plus other startups that week, probably in the same sector, plus existing portfolio needs that I explained, follow-on rounds, etc. Their fund theses and timing valuation environment. So essentially, they also focus on, let's say, before this there was a session by a gentleman from Sugar Cosmetics. So that's been a fund winner for multiple VC funds. For their follow-up rounds, the VC funds will double down on those funds to make sure their ownership is maintained. That's also part of their core mandate, in addition to making sure the fund in addition to making sure the fund gives a return to the LPs. Now, why do VCs pass on various founders? Some basic filters that they use. One is check size. What is check size? Whether I'm looking to raise 1 CR to 5 CR, 5 CR to 10 CR. Every VC fund has its own check size. Every founder requires this is the amount of money I need to move to the next round. So check size, mismatch geography, sector thesis, or ownership. Now, founders interpret VC interest as social proof. This is where the psychological social validation proof comes into play, where founders see when once in the newspaper you must be reading multiple articles that this company raises this much valuation. Even every day there are multiple articles that come. Business plan I know for the second page towards the end. So that's essentially, for them, that's social proof. And for them, essentially, investors interpret founders' enthusiasm as salesmanship. But for a founder, the way they can pitch it as an investment case is why this market can be huge, why economies can scale, why the round structure and the fund part to ownership plus returns helps the VC fund, and also accept allocation system is a funnel math, it's brutal, but ultimately be cognizant of the fact that if there are 100 applications that come to a VC fund, only 2 would be looked at. And out of those 2, only 2% of those deals would be essentially invested, which comes to my, so that's essentially how the entire part is. Next slide. So this is where I spoke about the funnel, where for founder the pain is, the pain is on various outreach to various investors. For VC, it's basically a funnel of cold inbound versus other channels where they get various companies to invest in. So first point, cold inbounds, or if you, let's say if you meet a VC fund and you get their email ID through some database and there's an email that you send. It has the lowest conversion rate. The reason why is because they do not spend more than 2 minutes or 5 minutes on a deck, and they look at the fit, signal, traction, team pedigree, warm, team pedigree, etc. What does work is warm introduction. So what is warm introduction? Anyone in the network, or if there is a portfolio company in their fund that refers another founder for that fund, or another investor who has invested, co-investor who has invested for a follow-on round, that helps. So warm, that helps, and essentially warm intros dominate the investor referrals And that's where the large share of deals also get funded. So they were, according to Bloom Ventures, which is an early stage VC fund based out of Bombay itself, 80% of the deals, I think the partner put out a report, 80% of the deals that was funded through them was funded through warm referrals, through referrals. And through the cold outreach, as I mentioned, they just looked at 2% of the deals that came in through cold outreach, and out of those 2%, only 2% were probably even seriously considered. The data for how many were funded was not put out, but that's the reason why cold outreach fails. So for VCs, it's just not. So for VCs or for founders, for that example, it's not just noise, but it's mistargeting. So for example, as a founder, I'm looking to raise funds for my company. I email 200 funds, but only 300 make the state sector check size, enforce, and essentially the conversion here, since only the fits here, the conversion is much worse. So here the fit, which is a filter, is even looked at where the company is fit for investing before quality. And there's a lot of hidden work that goes into fundraising. Once at all, it goes through the entire process. I'll quickly run you through the process. Once there's an initial outreach, then there is a associate that takes a call, then there is a deep dive call, then there's a partner call. Then partner call which explains the business model, the revenue model, the traction. Then there is pre-diligence that happens. They look at the revenues, MIS projections, whether the company fits in their mandates. And also the lot of reference checks that happen, and a data room that's created, Q&A investors, and the founders, in addition to managing all that, you need to understand they also need to run their business in parallel. So in terms of India context, the early stage VCs, highly, if you're in consumer, if you're in B2C space, which is gaining traction in the media, do not get funded to a large amount. If you see the data, tech weighted and B2B based for B2B based companies remains a large share of funding that happens in essentially the fundraising part. Next slide. So this I did mention a little. Why is good companies not investable? So essentially, a company that is good for VC, their power law essentially doesn't work, and that's why for them they need outlier potential, and the implication is VCs are not optimizing for 10x for this check, they are optimizing for the entire fund outcome. So that's why small is good for founders, small but solid companies, but they are not. There's essentially a distribution reality where venture funds are not able to return their funds. So 30-40% of the venture funds are not able to even return 1x of their capital to their limited partners. So for them, they are under a tight scanner to make sure that their funds are essentially deployed in the right manner. And that's why as I mentioned, they concentrate on breakout winners and rational under power law dynamics. So hence for the founder, essentially the point is for them, even though they feel the revenues are good, for VCs they look at the exponential returns. So this is where the math, including time, works differently for founders and investors. Next. So essentially for founders, a startup's runway is a hard deadline. A VC's fund has a multi-year deployment. So for startups, it's 7 to 10 months. They have 10 months, they need to raise funds, they need to operational capacity, they need to deploy funds, they need it for marketing, finance, various other things. Probably at max 15 months. For VCs, that time window is 7 to 10 years exit for the same fund. So for them, moving from one quarter to another quarter and delaying their fundraise is not as big as a problem. As for the founder, it might be the difference between whether the business is alive or whether the business might not survive over the next quarter. But for the VC, that if for them, essentially waiting the quarter also gives them an added advantage to make sure to see what traction is happening, how is the company performing, and also essentially how the company is performing and how the fund also returns and how their fund, if at all they invest, will return to the to the fund. Now this is where a concept I want to bring in is about IRR. You guys must have obviously learned it. So for VCs, they look to they care about time, but not to a large extent as founders. But IRR does penalize long durations. But for them, the time horizon is much larger. So hence, even if you see a good IRR for the AIF industry, so as you see, any good returns in terms of fixed instruments is 8 to 10%, considered 8%, 7% as per government bonds. Then above that, equity 10 to 15%. Anything above 20% is considered decent enough in the VC industry. So essentially, that's where the VCs concentrate on, and they are cognizant of the fact if I invest in 10 companies, 8 of them are going to fail. Probably 2 of them are going to give me a unicorn valuation, 3 to 4 are going to just chug along, and another balance 3 to 4 would just get winded up. So that's another point that the VCs also have in mind. So the practical founder, how can the founders essentially look at it? Is they can create urgency via traction, look at parallel interest, speak to other co-investors, run a process with explicit timelines. And if a VC is very non-responsive, just treat it as a no and move on to the next fund. So essentially, that's where it helps to save your time and to make sure the funds come in at the right time. Next. What's the point that can happen here? The VC, the founders should pitch, and this is what the savvy founders did happen. And I'll quickly explain what happened in the case of Physics Wala too. But the founders should pitch their company not as a product, but as an outlier. In terms of how can outlier be, let's break it down into components. One is market expansion, not just the target market on paper, but why the market is unlocking. Then what is the scale path, how you start narrow, but expand into much larger surface area. Next is the moat mechanism. What is the distribution, how you plan to distribute, what is the data, network effects, switching costs, how you make sure the unit economics are positive as you are scaling up, and also the compliance advantage. And finally, the capital efficiency. How 1 rupee spent. So there's this term that you guys must have come across, return on ad spend, ROAS. So essentially explain that, or multiple other terms, how the spend converts into compounding advantage. So how essentially, if you look at it through the VC lens, and you can explain how a VC looks at a company, essentially there's how they look at it in Silicon Valley, there's this term called grow fast or die slow. But if you understand this nuance and essentially place your company in such a way, then probably it also adds an advantage in terms of the VC. Now, in terms of what stage you are at, also you can look at, if you are at seed stage, then you look at story, founder market fit, early signals. Your job there is to make sure the outlier is plausible, because there won't be much data. You're only 2 years into operations. Once you're into Series A, there's repeatable go-to-market, plus retention, plus unit economics. Your job is to prove and back it up with data, early data, that the outlier is emerging. And once you're in Series B, C, you guys understand Series B, C, A, right? Beyond, as you progress across first stage of funding, second stage of funding, third stage of funding, it's Series A, B, C. So scaling predictability plus governance plus durable margins, the job is to show that the outlier is becoming inevitable. So if you sell this part of outlier well, then we move to the, then you might get term sheets. And that's where multiple of the negotiations take place. In the paper, you must be reading Physics Wala raised for 200 crores at $4 billion valuation. And don't quote me on the numbers, but the idea is higher valuation. But what I have seen in practice is the best looking term sheet or the highest headline valuation can be the worst deal if as it contains aggressive economics, control provisions, and I'll explain that in a minute. A cleaner deal with the cleaner terms at a slightly lower valuation can preserve far more headspace for the founder and also have more upside for the company rather than a more breakout valuation. So terms, what are the terms, basic terms that a founder should look at in terms of the term sheet? Two major points: economics, control. What is economics? In terms of economics, I look at what my valuation is, what my option pool is, and these are terms I'll run over, not needed to get in detail now. Liquidation preference, participation dividends. Liquidation preference comes into play when the company is raising a down round in a tight market and they're not able to raise rounds. That's when liquidation preference comes into play. Second part of the term sheet is control. This is where board seats, where essentially who handles the board, how many board seats does the investor get, protective provisions, veto rights, information rights. Information rights is every quarterly, so I need to prepare my MIS, my monthly information system, sales reports, audit reports. I need to share it with the investors. Tag along founder vesting and approval threshold. So once an investment happens, there's a founder vesting that happens. The idea for the VC is to protect his investment. So they would require essentially a 3 to 5 year lock-in. That's the standard terms. So those are broadly where the term sheets, some terms that come up in the term sheet and then followed by the SHA, which are the definitive documents. Then given why where do these toxic, there are now places where toxic terms does approach. Now during a funding slump, when a company is looking to raise certain rounds, certain funds, VCs essentially look at the pessimistic risk and they translate that into legal languages using preferences, vetoes, downside protection. And founders often see it late because they need to keep their company afloat, and probably there are companies that do raise funds. It has happened. There are companies that raise funds with a lot of terms that are not founder friendly. A rule that founders must essentially follow in this place while term sheet negotiation is looking at it as a pricing risk. If VCs is asking heavy protection, then the founders need to understand or ask, what risks are you seeing that is not being addressed? And also address the risk and probably refuse the protection. So what's the end game here? It's not founders versus VCs. So this is where essentially the VCs and founders should look at incentives, and both should be aligned. Fundraising feels adversarial because of asymmetries, but value creation is cooperative. The goal for a founder is to find an investor whose risk appetite and vision matches their company's path. So essentially, what does alignment mean? So they can be looked into three major buckets. One is outcome alignment. Are you both aiming for the same scale and timeline, or will exit tension appear later? Governance alignment. What decisions require approval, and will that help or hinder speed? Support alignment. What does the VC actually do post-investment, hiring, go-to-market, follow-on customers, and do you want your style? And finally, communication alignment. how information flows between the founders and the VCs. And here trust is the real currency. So one example that you guys, if you looked at Physics Wala, it was a bootstrap business for 10 years. It didn't raise any VC funds. 3-4 years ago, it did raise VC funds at a unicorn level valuation. And within the next 2 years, it incurred losses. It was a profitable business. Why did that happen? Because VCs wanted the outlier success. It did acquisitions beyond its unit economics could digest. But still, for VCs, it's still acceptable because for them, if it's an outlier success, I'm okay. It performs well for my portfolio. But for Physics Wala's case, they have corrected path now and in a much calmer, in a much cleaner way. So essentially, once the founder looks at this asymmetry, the mindset, they can look within essentially and essentially have a shift in the mindset where approval is not needed and the partnership should be negotiated between the investor and the founder. Last. So, the way the founder should look at it is they should not treat VCs as judges of their worth. They should treat them as counterparties in a long duration contract where terms and incentives decide behavior for years. Now, this is essentially how a founder should look at, and the basic checklist a founder can follow that operationalizes this partnership, being in this part, is fundraising should be run like a process, just like another department. There are multiple companies that does have an investor relations department. It should be run like so fundraising should be run like a process where target lists, warm intro strategies, pipeline tracking, consistent follow-up, CRMs, maintaining the checklist, maintaining the emails, maintaining all references, etc. should be made with the data room, with Q&A. Comes to my next point. Build a real data room early. You might not need funds as of now, but it's easy to keep a very clean data room which will have financials, cap tables, metric definitions, customer references, compliance basics, and once it comes to diligence, don't let that kill momentum. Understand the time asymmetry, set reasonable deadlines, and create momentum with traction and avoid being cornered by runway. So you should be cognizant of the fact that what's the amount of time I have to run my business so that I need the funds. So for example, I have only 12 months of runway left. I need to raise funds from 0 to 6 months to make sure by 8th month the funds are in so that I have 4 months buffer left. I should not be raising funds at 6 to 12 months where I'm at last 2 months left of runway. And essentially choose the right incentives, look at VCs as partners aligned on scale, pace and governance. And one point that founders should look at is deal isn't done until the funds are in to their bank account. Deals 40 to 50% of deals die in diligence. So one example for Go Mechanic. 3 years ago, SoftBank had a $75 million term sheet signed and funds to be invested. During diligence, it found out that the revenue metrics were not properly communicated. That came out. The funding didn't go through, and then we all know where Go Mechanic is today. So essentially, there are multiple other places where investments have collapsed during diligence. So now, this is one thing I'll quickly run through is how does a fundraising process work. There is an intro call, then there's a partner call, then there is a deep dive call, then there's a term sheet that's issued. Then this is where the due diligence happens, where the VC appoints a third party legal, financial, technical due diligence on the company. This takes 6 to 12 weeks depending on the company. There's a financial, legal, technical due diligence done, put back to the investments committee in the VC fund. This is where the VC fund goes cold to the founder, and then essentially post the diligence, post all the risks are highlighted, Then there's the definitive documents that are drafted, which is the shareholder agreement and the share subscription agreement. Then there are certain condition precedents. If there are certain risks that are highlighted, that does get drafted into the conditions precedent in the shareholder agreement. And then finally, once the SHA is signed, the funds are wired to the company. So one major takeaway I would like to close is if fundraising can become essentially easier if the founder stops trying to be liked and starts being investable, essentially through controlled risk, clean process, and through proper terms. So yeah, so this is what I wanted to quickly run you through. Okay, thank you guys.